Stop trading like a victim of the markets. Seriously. Most retail traders fail because, well, they're unknowingly following a script written by the people who actually move the price. Welcome to 3-Star Just Different. Today, we are stripping away all that noise, the lagging indicators, the classic retail patterns, to get down to the absolute truth of market movement. Because here's the thing, price does not move randomly. It's deliberately delivered to highly specific areas where large institutions, the smart money, can execute massive orders efficiently. So if you want to be profitable, you've got to stop being the liquidity and start following in the footsteps of the giants. This masterclass explainer is your deep dive into how institutional players actually dictate the markets.
Here is our game plan for today. We're going to cover beyond retail trading, the fractal market structure, understanding institutional bias, liquidity and price engines, high-value trading zones, and finally, we'll wrap it all up with a professional trade execution model. Let's get right into it.
Section 1. Beyond Retail Trading, Seeing What Smart Money Sees. We're going to fundamentally change how you look at a price chart by contrasting the everyday retail mindset with actual institutional reality.
The biggest illusion in trading is that markets are just a bunch of buyers and sellers naturally reacting to news. I mean, retail traders will stack their charts with so many lagging indicators it ends up looking like a piece of modern art, just hoping to catch a breakout. But the reality, institutions do not care about your MACD or your RSI. They exploit market structure, they engineer traps to grab liquidity, and they execute with absolute deliberate intent. Standard retail strategies often do nothing more than turn everyday traders into the exact liquidity that large institutions need to fill their massive orders.
Section 2. The fractal market structure, a top-down approach. To stop being that liquidity, you have to understand how smart money views time. So let's look at how they analyze time frames starting from the very top.
The market is entirely fractal. What does that mean? Well, what looks like a massive, complex downtrend on your 15-minute chart is really just internal structure, a tiny pullback on the daily chart's external structure. To actually know where price is headed, you have to map the macro institutional level, which is the 1-month chart. That dictates the intermediate level of the 1-week chart, which trickles right down to the 1-day short-term level. You literally cannot predict a 15-minute chart without first understanding the monthly and weekly macro directives. It just doesn't work. This brings us to a crucial rule. You are trading inside a day, inside a week, inside a month. When you open up your chart, you aren't just trading today's price action. You're trading inside a daily candle, which is forming inside a weekly candle, which is forming inside a monthly candle. The single biggest mistake retail traders make is analyzing from the 15-minute chart up to the daily. Professional, top-down analysis always starts at the month and works its way down.
Section 3. Understanding Institutional Bias, the OHLC and OLHC traps. Now that we've got the hierarchy of timeframes down, we need to talk about direction. Let's define market bias and expose how institutional traps are formed right inside those daily and weekly candles.
Institutional bias isn't just some gut feeling or a guess about whether the market will go up or down. It is the predetermined directional objective of the market for a specific time frame, driven entirely by smart money accumulation. Look, if you know the monthly bias is undeniably bullish, then every single drop you see on the daily chart isn't a reversal, it's a discounted buying opportunity.
This bias is exactly how institutions trap retail traders using daily or weekly candle sequences. Let's say the true bias is bullish. The candle opens. Then, it creates fake momentum downward. This is called inducement, and it is the ultimate psychological weapon. It triggers retail sell orders and hits the stop losses of the early buyers. Once the smart money has collected enough of those orders, boom, the real expansion happens. A massive move upwards. Then, the candle closes. If you don't understand this open, low, high close sequence, you are going to panic sell during that fake momentum, right before the market explodes in the true direction.
Section 4. Liquidity and price engines. Why price actually moves. This brings us to the fundamental engine of the entire market. Let's talk about liquidity. I want you to pause and really think about this for a second. Why does the price actually move? You might say, well, buying and selling pressure. Sure. But for institutions managing billions of dollars, price moves for one primary reason: to seek liquidity.
In the real world, liquidity is just clusters of pending orders, usually retail stop losses. Institutions need thousands of sellers to fill their massive buy orders. So where are they finding them? Right at key levels like the previous day high or low, the previous week high or low, and especially at equal highs or equal lows. Retail traders love to call this clean support and resistance, but to an institution, clean support is just a giant pool of sell stops waiting to be triggered. They intentionally push the price below that support, trigger all your stops, buy up those assets at a huge discount, and then reverse the market.
Let's look at a highly actionable rule straight from our source material. If the market aggressively drops below the previous day low, sweeping that liquidity, but then quickly reverses and closes above it, the smart money has essentially refueled. They took the stop losses, filled their massive orders, and now the next day's institutional bias is officially up. That is your signal to look for buys. Section 5. High-value trading zones where smart money accumulates. So we have our bias, and we know they sweep liquidity. But where exactly do we enter? Let's identify the specific points of interest, or POIs, where smart money accumulates.
Your two most critical institutional zones are order blocks and fair value gaps. An order block is the very last opposing candle before a strong, impulsive move breaks structure. It is quite literally the footprint of a massive institutional order. A fair value gap, on the other hand, is an inefficiency. It's an imbalance created when price expands so rapidly that there just wasn't time for buyers and sellers to fairly trade. These gaps act like magnets. Price will almost always retrace to fill them before continuing its trend.
Now, the true secret to these zones lies in how they overlap. The source material outlines several advanced zones, like mitigation blocks and volume imbalances. But your highest probability edge comes from overlapping zones. When you find a breaker block that directly overlaps with a fair value gap, you have found an incredibly strong point of interest. That double-layered zone is where smart money is practically guaranteed to defend their positions. Section 6. Professional Trade Execution Model, putting it all together. All right, we've covered the theory. Now, how do we actually trade this? Let's walk through the mechanical steps to execute a professional entry model.
Here is your professional blueprint. Step 1. Always identify your macro bias first. Do not even touch a 15-minute chart until you know what the month and week are doing. Step 2. Mark your high-value zones, your order blocks and FVGs on the higher time frame. Step 3. Sit on your hands and wait. Let the market induce retail traders. Wait for the price to sweep a previous day's high or low, grabbing that liquidity right into your marked zone. And finally, step 4. Drop down to a lower time frame, like the 15-minute or 1-minute chart. Wait for a change of character, a CHoCH, with strong displacement. That structural shift is your final confirmation to enter exactly where the institutions are entering.
At 3-Star Just Different, we always say that we don't just trade the chart, we read the story behind it. Trading isn't about memorizing rigid retail patterns. It's about reading the underlying narrative of the market. It's about understanding institutional intent. And most importantly, it requires the supreme discipline to just wait for the market to come into your highly specific zones before you risk a single dollar.
I'll leave you with this thought as you pull up your charts today. Every single trade needs liquidity. Someone has to lose for someone else to win. Are you going to continue relying on lagging indicators and serve as the liquidity for the big players? Or are you ready to use this structured analysis, map the macro bias, identify the traps, and finally trade alongside the institutions? The choice is absolutely yours. Thanks for joining me on this explainer. Stay disciplined and keep learning.